Today's Wall Street Journal. We're breaking down the biggest business stories of the day, what happened, why it matters, and where the incentives really are. First article from Journal: Amazon shuts down Fresh. Go grocery sites: Amazon is shutting down all 72 of its branded grocery stores. 57 Amazon Fresh locations. 15 Amazon Go locations. All gone. After more than a decade of experimentation, billions of dollars in investment, and countless promises that technology would revolutionize physical retail, Amazon is admitting, we failed. But here's what matters. This isn't a story about Amazon losing. This is a story about capital allocation, about how founders can become constraints on their own businesses, and about what happens when a company keeps throwing good money after bad. Let me explain what happened and why it reveals something profound about how even the best companies can make catastrophic capital allocation mistakes. Amazon Go was supposed to be revolutionary. The concept was simple. Walk in, grab what you want, walk out. No cashiers, no checkout lines. Computer vision and sensors would track everything you picked up and charge your Amazon account automatically. Amazon was going to use artificial intelligence and computer vision to eliminate friction from retail. Jeff Bezos loved this vision. Bezos is obsessed with removing friction. He removed friction from book shopping by making everything searchable and available in seconds. He removed friction from logistics by promising one-day delivery. The idea of removing friction from grocery shopping, making it so fast and effortless that you don't even have to wait in a line, this was a Bezos idea, through and through. Amazon Fresh was supposed to be the mass-market version. Amazon Go was a high-tech, ultra-premium convenience store. Amazon Fresh was going to be the place where regular people bought their groceries at cheaper prices than Whole Foods. Same technology, scaled up, available to everyone. The problem is, it didn't work, and it took a decade to figure out. Here's what Amazon said in their official statement. Its branded stores failed to deliver a distinctive customer experience with an economic model that could be scaled up. Let me translate that. We spent billions of dollars building stores with amazing technology, but people didn't want the technology, and we couldn't make it profitable. The economic model didn't work because the technology was too expensive. You have to put computer vision cameras in every part of the store. You have to build sensors into every shelf. You have to process massive amounts of real-time data to track every item and every customer. That infrastructure costs money. That reduces margins. In the grocery business, margins are razor thin. 2 to 3% in many cases. You can't afford expensive infrastructure if your margin is 2 to 3%. And the customer didn't really care. People go to grocery stores because they want cheap groceries and convenient parking. They don't care about walking up to a sensor and grabbing an item. They're willing to wait in a checkout line if it saves them $1 per transaction. The technology doesn't matter to them. Amazon was solving a problem that customers didn't have, and that didn't have economic value anyway. But here's the capital allocation question. Why did it take a decade to figure this out? The answer is because Bezos believed in the vision. Because Amazon has enough money that they can afford to be wrong for a long time. Because nobody in the organization had enough standing to push back on the founder's idea until the losses became undeniable. Founders can be constraints on their own organizations. When a founder falls in love with a vision, when they believe deeply that this is the future of retail, the entire organization tends to follow. You don't question the founder. You execute the vision. You build the stores. You deploy the technology. You hope it works. When it doesn't work, you adjust and try again. 10 years later, you realize it's not going to work. We should have known this earlier. We should have killed this 5 years ago. That's what we're seeing now. Amazon is finally killing the program. But Amazon Fresh has been losing money for years. Amazon Go has been a showcase technology that nobody wanted. The stores were beautiful. The technology was impressive. But they weren't profitable. And they weren't going to become profitable because the fundamental economics were broken. Now Amazon is doing what it should have done a decade ago, converting the Amazon Fresh stores into Whole Foods locations, and closing or repurposing the Amazon Go stores. Amazon acquired Whole Foods for about $13.5 billion in 2017. Whole Foods is a real grocery business with real customers and real margins. Whole Foods is not going to revolutionize retail with computer vision. Whole Foods is going to make money the old-fashioned way. Good products, knowledgeable staff, premium pricing, and a loyal customer base. Amazon is now planning to open more than 100 new Whole Foods stores in the coming years. That's real capital deployment. That's Amazon acknowledging the premium grocery business with Whole Foods already works. Let's expand that rather than keep investing in the Amazon Fresh fantasy. Here's what makes this interesting from a capital allocation perspective. Whole Foods is a good business. It's profitable. It has loyal customers. It's not as exciting as Amazon Go. It's not as technologically revolutionary, but it's real. It works. It makes money. Meanwhile, Amazon Fresh was exciting. It was revolutionary. It was going to change how people shopped for groceries. But it didn't work. And Amazon finally admitted it. The question investors should ask themselves is, how long is a company willing to stay committed to a vision that isn't working? How long is a founder willing to throw capital at a strategy that isn't delivering returns? The answer, for Amazon, was about a decade. That's a long time to be wrong. Now let me talk about what this reveals about Amazon's capital allocation more broadly. Amazon has been phenomenal at capital allocation in e-commerce. Amazon reinvested profits into logistics and delivery and customer satisfaction. That worked. Amazon's investments in AWS and cloud computing were transformative. That worked. But Amazon's physical retail bets have been inconsistent. Whole Foods was acquisition, and that's working now that Amazon is expanding it. But Amazon Fresh and Amazon Go were organic attempts to reinvent retail from scratch. Those didn't work. The difference is often that acquisitions come with existing customer bases and existing economics. If you buy a company that's already profitable, you get a productive asset. Amazon Go and Amazon Fresh were built from the ground up with the assumption that technology would create new economics. That assumption was wrong. Here's the deeper truth about capital allocation. Technology doesn't automatically create value. Technology can reduce friction. Technology can improve efficiency. But if customers don't care about the friction or the efficiency gains, technology doesn't matter. Amazon learned this lesson the hard way. The lesson is, never fall in love with technology for its own sake. Always ask, do customers want this? Are they willing to pay for it? Is there real economic value here? Amazon didn't ask those questions deeply enough about Amazon Go or Amazon Fresh. Amazon assumed that if you eliminated friction with technology, customers would flock to the stores. That assumption was wrong. Now Amazon is refocusing on what works. Whole Foods as a premium grocery brand with real customers and real economics. That's smarter capital allocation. On screen, I'd show you the store closures. 57 Amazon Fresh. 15 Amazon Go, 72 locations disappearing, some converted to Whole Foods, others just gone. But the visual evidence is incomplete without understanding what happened over the decade before this. Amazon was supposed to have disrupted grocery retail with technology. Instead, Amazon is now conceding that the old-fashioned grocery model, good products, knowledgeable staff, reasonable pricing, is better than the high-tech alternative. That's the real story. Let me extract 3 timeless lessons from Amazon's Fresh and Go failure. First, technology is not a strategy. Technology is a tool. If you're investing billions in technology to solve a problem that customers don't have, you're not being innovative. You're wasting capital. Amazon built computer vision systems and sensor infrastructure to eliminate checkout friction. But customers don't value checkout friction elimination enough to pay premium prices. The lesson is, start with the customer need. Ask what customers want. Then ask if technology can solve for that need profitably. Don't start with cool technology and assume customers will want it. Second, founders can become constraints on capital allocation when they fall in love with visions that don't reflect market reality. Bezos fell in love with the idea of frictionless retail through technology. The organization followed Bezos. For a decade, billions flowed into Amazon Fresh and Amazon Go. If this had been a smaller company, it would have been bankrupt. But Amazon has so much cash that it could afford to be wrong for 10 years. Smaller companies don't have that luxury. The lesson is, structure your organization to make sure someone is willing to push back on the founder's vision when the data contradicts it. Diversity of thought prevents billion-dollar mistakes. Third, acquisition of an existing business with proven economics is often better capital allocation than building from scratch. Amazon spent a decade and billions trying to create Amazon Fresh and Amazon Go. Then Amazon realized that Whole Foods, which Amazon had already acquired, was a better platform. Now Amazon is expanding Whole Foods instead of investing in Amazon Fresh. The lesson is, sometimes the best capital allocation decision is to expand what's already working rather than keep trying to make the new thing work. Acquisitions of profitable businesses are often undervalued as capital allocation choices because they're boring. But boring and profitable beats exciting and unprofitable. Here's my closing conviction. Amazon is one of the best managed companies in the world. But even Amazon wastes billions of dollars on capital allocation mistakes. The difference is that Amazon can afford the mistakes. A smaller company with the same capital allocation discipline would have been bankrupt. That's why this story matters. It shows that even the best capital allocators in the world make massive mistakes when they fall in love with visions that don't reflect market reality. The lesson for value investors is, always question whether a company is invested in a vision because the fundamentals support it, or because the founder fell in love with the idea. If it's the latter, be skeptical of future capital allocation decisions in that direction. Here's the sentence you'll remember. When a company admits after a decade that an entire strategic direction failed and the economics were broken, that's not a pivoting CEO being flexible. That's evidence that the organization didn't have the conviction or courage to kill a bad bet earlier. Moving to next title, Pinterest to cut about 700 jobs. Pinterest is laying off 700 workers. That's roughly 15% of the company's 4,666 full-time employees. The restructuring will eliminate jobs across the organization, reduce office space, and cost up to $45 million in after-tax charges. But here's the part that tells you everything about what's really happening. Pinterest is not laying off to survive. Pinterest is laying off to pivot toward artificial intelligence. The company is reallocating resources to AI-focused roles and teams. Pinterest is prioritizing AI-powered products. Pinterest is betting the company on the belief that AI can solve a problem that the core business can't: declining advertising revenue. This is a capital allocation story about a company in decline trying to transform itself by chasing a trend. Let me explain what happened to Pinterest and why this matters. Pinterest makes money through advertising. That's it. Advertisers pay to put ads in front of Pinterest users. The platform shows ads when users are pinning, browsing, searching for ideas. The revenue per ad, the advertising pricing, is the key metric that matters. In the third quarter of 2025, Pinterest's advertising pricing declined 24% year over year. That's not noise. That's not a slight dip. That's a collapse. 24%. The reason? U.S. retailers were navigating what the company called tariff-related margin pressure. They were worried about tariffs. They were worried about their own margins. So they cut advertising spending. Specifically, larger companies cut advertising spending. Pinterest lost pricing power with its biggest advertisers. Think about what that means for a company whose entire business model depends on advertising. When your advertising customers get nervous and cut spending, your pricing power disappears. You can't maintain advertising rates. You have to compete on price. Your margins compress. Your revenue falls. That's what happened to Pinterest. The stock has lost roughly 30% of its value over the past year. 30%. That's stock price destruction. On Tuesday, Pinterest shares fell 9.6%. Pinterest's chief financial officer, Julia Donnelly, said it plainly. The advertising market is weak. Pressure on advertising spending is expected to continue in the near term. Translation: we're expecting more pain. Here's where the capital allocation decision becomes interesting. Instead of waiting out the advertising downturn, instead of managing the business for cash and efficiency, Pinterest is doing the opposite. Pinterest is laying off workers, but not to save cash. Pinterest is laying off to create capacity to hire people focused on artificial intelligence. The company is betting that AI-powered products will drive new revenue. The company is betting that AI will help it keep users find and purchase products in the images they pin. The company is betting that this will attract new kinds of advertisers who haven't been on Pinterest before. That's an aggressive bet. That's a bet that says, the current advertising business is broken. We can't compete on pricing anymore. Our traditional advertisers are cutting spending, so we need a new business model. We need AI. We need to transform. The problem with this capital allocation decision is timing. Usually, You invest heavily in new initiatives when you have excess cash flow and growing profitability. You fund the transformation from a position of strength. Instead, Pinterest is funding AI development while advertising revenue is collapsing, while pricing is down 24%, while pressure is expected to continue. This is transformation under duress. This is a company forced to reinvent itself because the old model isn't working anymore. Now here's the question that investors need to ask. Is AI actually going to solve Pinterest's problem? Or is Pinterest chasing a trend because management needs to show that they have a vision for the future? Let me be honest, I don't know if AI will save Pinterest. But I know that advertising-dependent businesses that lose pricing power have a very hard time recovering. Once your advertisers stop believing in you, once they cut budgets and look elsewhere, it's very hard to win them back. The recession doesn't last forever. Eventually, budgets come back, but they might come back to different platforms, to different competitors, to places where advertisers have already shifted their spending. Pinterest's bet is that AI will be different, that AI will create new value for advertisers, that AI will create new reasons for them to come back to Pinterest. But here's the uncomfortable truth. Pinterest lost ground to TikTok and Instagram years ago. Pinterest is not the platform where users go for discovery anymore. Pinterest is a platform for specific niche use cases: wedding planning, interior design, recipe inspiration. Those use cases are real, but they don't attract the mass market advertisers that drive the biggest ad budgets. When those advertisers cut spending during a tariff-related panic, it hits Pinterest hard because Pinterest's advertiser base is already concentrated. It's already specialized. It's already more vulnerable to cyclical cuts. So when Pinterest says it's going to invest in AI to solve this problem, investors should ask, does AI actually solve the core issue, which is advertiser concentration and cyclical weakness? Or is AI a distraction from the real problem, which is that Pinterest's business model is fundamentally less resilient than its competitors? I think the answer is, AI is probably not going to solve this. AI might help. AI might enable better targeting, or measurement, or creative tools for advertisers. But AI is not going to convince CPG companies to increase spending on Pinterest if they're worried about tariffs and margins. Let me show you what the market thinks. On screen, you're seeing Pinterest stock performance over the past year. The stock is down roughly 30% from peak to trough. That's sustained, relentless decline. That's not a temporary dip that AI is going to fix in a quarter or two. That's the market recognizing that Pinterest has a structural problem. The share price has lost value because the business is less valuable. Advertising pricing is down 24%. Advertiser concentration is weak. The core business is struggling. Laying off 15% of the workforce and investing in AI doesn't change the structural problem. Now, here's where I want to point out what good capital allocation would look like in this situation. Good capital allocation in a downturning advertising market would be cut costs aggressively, reduce headcount where necessary, preserve cash, focus on profitability rather than growth, weather the storm, wait for advertising markets to recover. Then, invest in growth from a position of strength. What Pinterest is doing instead is cut costs, but use the savings to fund AI development. The idea is that AI will drive new growth and new revenue streams so fast that it offsets the advertising decline. That's a higher risk bet. That's a bet that says, the old model is done. We need a new model. And we need it now. Sometimes that bet works. Sometimes a company in decline finds a new business model or new product that drives growth. But more often, it doesn't work. More often, a company in decline uses the cost-cutting as cover to invest in speculative bets that don't pan out. Then, 2 years later, the company is smaller, weaker, and the problem hasn't been solved. I think there's a real risk that Pinterest is in that category. The company is laying off to invest in AI because it has no choice. It's not because AI is the obvious solution. It's because the advertising business is broken and Pinterest needs to do something. Let me extract 3 timeless lessons from Pinterest's situation. First, when a company's core business loses pricing power with customers, investing heavily in new initiatives is a high-risk bet. Pinterest's advertising customers cut spending by 24%. That's a sign that something is fundamentally wrong with the way those customers perceive value in Pinterest's platform. Laying off to fund AI doesn't fix that. It might help, but it's a distraction from the core problem. The lesson is, when you lose pricing power, fix the core business first. Then invest in new initiatives. Don't bet the company on transformation when the current model is broken. Second, transformation under duress is much harder than transformation from a position of strength. Pinterest is forced to pivot to AI because the advertising business is failing. If Pinterest had chosen to invest in AI from a position of strength, with growing advertising revenue and strong cash flow, the investment would be much more likely to succeed. You'd have runway. You'd have flexibility. You'd have the ability to take risks. Instead, Pinterest is under pressure. That pressure constrains decision-making. It limits options. It increases the risk that the AI bet won't work. Third, advertiser concentration and cyclical dependence create structural vulnerability. Pinterest's advertising base is concentrated among larger companies. Those companies cut spending together during downturns. That creates a cliff for revenue. A more diversified advertising base, small businesses, vertical players, niche advertisers, would be more stable, but building that is hard and slow. Chasing AI transformation is faster and more exciting, but it doesn't solve the structural problem of concentration and cyclicality. Here's my closing conviction. Pinterest is in a difficult position. The advertising business is failing. Pricing is down 24%. Larger advertisers are cutting spending. The company needs to transform, so management is laying off to invest in AI. It's a defensive move, wrapped in the language of transformation. It might work. AI might drive new capabilities that attract new advertisers. Pinterest might rebuild the business on a different foundation, but the odds are long. Most companies that pivot away from a failing core business don't successfully build a new one. Most companies that cut costs to fund unproven initiatives end up smaller and weaker, not bigger and stronger. Pinterest shareholders are betting on a transformation, but based on the stock's performance, down 30% over a year, I think the market is skeptical that the AI bet will pay off. The market thinks Pinterest is in structural decline, and no amount of AI investment changes that if the underlying problem is advertiser concentration and cyclical weakness. Here's the sentence you'll remember. When a company lays off workers to fund AI transformation while its core business is collapsing, that's usually a sign that the company has run out of better options, not that it has found the future. Moving to next title, Johnny Rocket's parent seeks bankruptcy. No exit strategy. No plan. Just a company with 2,200 locations, including Fatburger and Johnny Rockets, and $1.4 billion in debt that lenders refused to refinance. The stock fell 34% to 26 cents. 26 cents. That's not a stock. That's a rounding error. But here's what I want you to understand about fat brands. This isn't a story about restaurant industry headwinds or changing consumer preferences or macro weakness. This is a story about a founder-led company that was built on fraud, over-leveraged to the point of no return, and deliberately hid its true financial condition from investors. Let me tell you what happened. Andrew Wiederhorn is the CEO of @Brands. In December, Wiederhorn reached a deal with the SEC pending regulatory approval. The SEC had filed a complaint against him in 2024, alleging that he used almost $27 million in company cash for personal expenses. $27 million. Not a small amount, not a gray area. That's clearly company money being diverted to CEO lifestyle. But that's not the only allegation. Kevin Gordon, head of structured credit at Alanya Advisors, a bondholder, sued @Brands in December, alleging that the company inflated its financial position by accounting for short-term financing transactions as cash on its balance sheet, hiding them from investors. That's fraud. That's hiding debt. That's making the balance sheet look better than it actually is. @Brands denied those allegations, but then @Brands itself sued Alanya Advisors in July, alleging fraud and breach of contract over a trade. Alanya denies the claims, so you have the CEO using company money for personal expenses, you have the company inflating its financial position to hide debt, you have multiple parties suing each other, and nobody trusting anyone. All told, the legal situations have cost @Brands nearly $85.5 million since 2021. That's legal fees, settlements, and the damage done to the business while the leadership was tied up in litigation instead of running the company. Now here's the capital allocation story. @Brands took on $1.4 billion in debt, That debt is primarily held in special purpose vehicles. That's jargon for structured debt that's designed to be hard to understand and hard to track. The company used this debt to acquire brands, operate restaurants, and apparently fund CEO expenses. For more than a year, FAT Brands has been in talks with lenders to restructure this debt out of court. But agreements didn't materialize. Lenders looked at the business. They looked at the litigation. They looked at the CEO's fraud allegations. They looked at the accounting allegations. And they said, no, we're not refinancing this. We're not giving you more time. We're not renegotiating. You're done. That's the moment when capital allocation failures become undeniable. When lenders won't refinance. When the market says, your business model doesn't work. Your management can't be trusted. Your balance sheet is fake. You're finished. FAT Brands entered bankruptcy with what they called extremely limited cash on hand. That means the company was out of cash. The company had no liquidity. The company was forced into Chapter 11 because it couldn't pay its bills. Now let me talk about the structural problem that underlies all of this. FAT Brands owns several restaurant brands, some company-owned stores, mostly franchised locations, roughly 700 franchisees operating 1,900 locations globally. FAT Brands also operates a manufacturing plant that supplies raw cookie dough and dry pretzel mix to its locations. The company owns Johnny Rockets, Ponderosa Steakhouse, Bonanza Steakhouse, Twin Peaks, and Smoky Bones. This is a franchise model. The company makes money from franchisees, through royalties, through franchise fees, through supply agreements. The company owns a small number of company-operated stores for its own profit. It's a traditional QSR franchise structure. But the company took on $1.4 billion in debt for this business model. Think about that. $1.4 billion. For a franchise restaurant company with modest cash flow, that's over-leveraged by any measure. That's a leverage multiple that assumes perfect execution, perfect growth, no recessions, no legal troubles, no fraud allegations, no CEO using company cash for personal expenses. It's impossible. It was always impossible. And the lenders eventually figured that out. Here's what's revealing. The lenders tried. Starting last summer, FAT Brands began discussions with note holders to try to restructure the finances out of court. That's how these things usually work. The lender group realizes the company is troubled. They sit down, they renegotiate the terms, they give the company a bit more time to fix its problems. That's standard. But the lenders wouldn't do a deal with FTA Brands. The lenders said, no, we're done. We're not refinancing. We're not extending. We're not negotiating. That means the lenders looked at the company and realized, this is unsalvageable. The CEO is allegedly committing fraud. The balance sheet is allegedly fake. The business model can't support this debt. There's no path to profitability. There's no path to growth. This is a liquidation situation. And indeed, that's what happened. FAT Brands filed for bankruptcy, with no financing lined up. No plan, just an attempt to go into Chapter 11 and figure out what to do next. The company says it will operate with extremely limited cash on hand and a 4-week budget. That's not a business plan. That's a death spiral. That's a company trying to survive week to week, while management tries to figure out how to sell assets or restructure or somehow keep the lights on. The stock is at 26 cents. The company owed $1.4 billion. You do the math. There's virtually nothing left for equity holders. Everything is being fought over by creditors. Now let me talk about what this reveals about founder-controlled companies and capital allocation. Wiederhorn controlled FAT Brands. Wiederhorn had the ability to set strategy. Wiederhorn had the ability to raise debt. Wiederhorn had the ability to use company money, allegedly for personal expenses. Wiederhorn had the ability to hide information from lenders and investors. And Wiederhorn drove the company into bankruptcy through a combination of over-leveraging and fraud. This is what happens when a founder has complete control without accountability. Boards that are stacked with founder-friendly directors don't ask hard questions. Lenders rely on management's financial information. If management is hiding information or inflating the balance sheet, lenders don't know. Investors trust management to act in the company's interest. If management is using company cash for personal expenses, investors don't know. The system assumes honesty. The system assumes that management is trying to maximize shareholder value. The system assumes that boards are providing actual oversight. When those assumptions break down, When the founder is committing fraud, when the board is failing to oversee, when management is hiding information, the entire structure collapses. That's FAT Brands. That's a textbook example of founder control without accountability leading to fraud and bankruptcy. Now here's the investor lesson. When you're evaluating a founder-controlled company, especially one with significant debt, you need to ask very specific questions about governance, about board independence, about the founder's incentives, about what would happen if the business turns down. Wiederhorn controlled FAT Brands. If the business had no other options, if he couldn't raise debt, if franchisees were leaving, if the company couldn't grow, what would happen? Well, we found out. Wiederhorn allegedly started using company cash for personal expenses. Wiederhorn allegedly started hiding debt from lenders and investors. Wiederhorn's company inflated its balance sheet. When the company couldn't refinance and the lenders looked closely, everything fell apart. This is a cautionary tale about the dangers of concentrated founder control combined with over-leveraging. Let me extract 3 timeless lessons from FAT Brands. First, when a founder has complete control and the company is heavily leveraged, the risk of fraud or self-dealing is much higher than in companies with distributed oversight. Wiederhorn used company cash for personal expenses. Wiederhorn allowed the company to hide debt from investors. Wiederhorn was willing to misrepresent the financial condition to keep the company alive. The lesson is, concentrated founder control plus high leverage plus weak board oversight equals very high fraud risk. Investors should avoid these combinations or demand much higher returns to compensate for the risk. Second, over-leveraging a business model that can't support the debt is not a capital allocation decision. It's a catastrophe waiting to happen. FAT Brands took on $1.4 billion of debt for a franchise restaurant business with modest cash flow. That's not ambitious. That's not strategic. That's impossible. The company had no path to deleveraging. The company had no margin of safety. When things got even slightly worse, when the CEO's fraud came to light, when lenders looked more closely, the whole thing collapsed. The lesson is, leverage must be matched to the business's ability to service debt and refinance. When there's a mismatch, bankruptcy is inevitable. Third, special purpose vehicles and complex debt structures designed to be hard to understand are often a warning sign that the company is hiding something. FAT Brands' debt was primarily held in special purpose vehicles. That's not an accident. That's deliberate structuring to make the debt less visible, less trackable, harder for investors to understand. When you see that, you should ask, why? What's the company trying to hide? Usually, the answer is something bad. In FAT Brands' case, the answer was fraud, over-leveraging, and misrepresentation of financial condition. Here's my closing conviction. FAT Brands is not a unique failure. It's a repeat of a very old pattern. Founder-controlled company, concentrated debt, weak governance, fraud, bankruptcy. It happens over and over again. It happens because founder-controlled companies can become kingdoms. The founder's interests can diverge from shareholder interests. The founder can start treating company resources as personal resources. The founder can mislead lenders and investors to keep the company alive. The board doesn't push back because the founder controls the board. Lenders don't push back until they realize the balance sheet is fake. By then, it's too late. The company is bankrupt. The shareholders are wiped out. The creditors take haircuts. And the founder walks away to start again. That's what's happening to FAT Brands. The company is bankrupt. The stock is worth 26 cents. The lenders are fighting over the remains. And Wiederhorn, despite the SEC allegations and the fraud accusations, is still fighting to control the company through the bankruptcy process. This is what founder control without accountability looks like at the end. Here's the sentence you'll remember. When a founder-controlled company can't refinance its debt, the first place to look is fraud or misrepresentation, because that's often why lenders finally say no. Moving to next title, Boutique Hotel, Pioneer sets revamp for a stalled brand. Ian Schrager is trying to revive his hotel brand at 79 years old. He's been trying for 15 years. He's opened one hotel in New York. Now, he's partnering with Highgate, one of the country's largest hotel managers, to acquire existing hotels, build new ones, and convert current Highgate properties all under the public hotel's flag. This is a capital allocation story about a legendary founder who created an entire industry, the boutique hotel business, and then couldn't scale his own brand. Until now. Maybe. Let me tell you who Ian Schrager is and why this matters. Ian Schrager is 79 years old. He's the co-founder of Studio 54. That was the most famous nightclub in New York in the 1970s. Then he moved into hotels. He co-founded Morgan's Hotel in New York with Steve Rubel. Morgan's was the first boutique hotel. Morgan's literally invented the boutique hotel industry. The property spawned an entire category. It grew into a portfolio of more than a dozen hotels before Schrager sold his stake in the mid-2000s. Then Schrager partnered with Marriott to develop the Edition lifestyle hotel brand. That partnership ran for 14 years, opening 15 hotels in 14 countries. Schrager knows how to build brands. Schrager knows how to create hospitality concepts that resonate. Schrager has proven it again and again. But with public hotels, Schrager has failed. And that's the story. Schrager launched Public in 2011 with a hotel in Chicago. At the time, he said he was targeting up to 15 openings within 7 years. That was the plan. 15 hotels in 7 years. Ambitious, executable. But it didn't happen. He sold the Chicago hotel in 2016 for $60 million. That was roughly equal to the amount he and Morgan Stanley spent purchasing and renovating the property. So he broke even, but he had no hotels under the Public brand anymore. Then the New York location opened the following year. It's a 367-room hotel, known for a young and trendy clientele, including celebrities. It has a nightclub. The rooftop bar hosts a New Year's Eve party. The property is profitable. The property works. But it's one hotel. 15 years later, Public has only 2 hotels in operation. One in New York. One scheduled to open in West Hollywood in spring 2026. That's it. That's 2 hotels in 15 years. Why? Schrager says his work with Marriott on the Edition brand slowed the expansion of Public. He said, "Even though I had no prohibition on expanding Public, I don't think that they really would have liked it. I think they would have thought of it as a distraction." So Marriott didn't own Public. Marriott didn't prevent Schrager from expanding Public. But Marriott's partnership took up Schrager's time and attention. And the Edition brand was so successful that expanding Public got deprioritized. The Marriott partnership ended in 2022. But by then, 15 years had passed and Public was still just a single property. This is the capital allocation story. Schrager had a brand. Schrager had a vision. Schrager had a track record of success. But Schrager couldn't execute at scale. So Public stagnated. Why couldn't Schrager execute? I think there are a few reasons. First, Schrager is a creator and a visionary, not an operator at scale. Schrager excels at conceiving unique hospitality experiences and opening individual hotels. Schrager is brilliant at that. But scaling a hotel brand requires operational discipline, standardized processes, financial controls, the ability to delegate, the ability to manage multiple properties simultaneously. Those are different skills. Schrager is not a chain operator. Second, Schrager was distracted. The Marriott partnership took his time. Schrager had to balance developing the Edition brand while trying to expand Public. That's difficult. That's a split focus. When you have a split focus, neither initiative gets the attention it deserves. Third, and most importantly, Schrager had a capital constraint. He had one profitable hotel in New York. One. And he was trying to expand the brand. But you need capital to expand. You need to acquire properties or build new ones. You need to fund pre-opening costs. You need to cover the losses before hotels become profitable. Schrager secured a $310 million debt refinancing last month on his New York hotel. But that refinancing was on the existing hotel. That capital wasn't available for expansion. Schrager didn't have the capital he needed to scale Public. So the brand stagnated. Now, Schrager is partnering with Highgate. Highgate owns or manages more than 400 properties globally. Highgate has the scale, the capital, the operational infrastructure to expand brands. Highgate will join Schrager on hotel purchases and management contracts under the Public flag. Highgate won't have an ownership stake in Public. But Highgate will be the operational partner. This is how stalled founder brands get revived. Not by the founder figuring it out alone, but by the founder partnering with someone who has the operational scale and capital to execute. The question now is, does this partnership work? Can Schrager and Highgate together build Public into a significant brand? Here's what I think is happening. Schrager has realized something about himself at 79. He said, I want to have a big company because I've never done it before. That's a direct quote. Schrager has created iconic brands. Schrager has proven his ability to design and open unique hotels. But Schrager has never scaled a company to significant size. He's never built a brand with dozens or hundreds of properties. So now, at the end of his career, Schrager wants to do something he's never done before. That's a human motivation. That's ego. That's the desire to leave a legacy. I understand it, but it's also potentially dangerous for capital allocation. When a founder's motivation is personal legacy rather than shareholder returns, the capital allocation decisions can be questionable. Schrager is shifting away from the expensive restaurants and bars that made his past hotels famous. He's shifting to fast casual and takeout food from third-party operators. The New York hotel will work with Union Square Hospitality Group's Danny Meyer on food and beverage. But the model is simpler. It's more focused on efficiency. It's more focused on margins. That's smart. That's learning from experience. The rooftop bars and nightclubs are great for brand identity, but they don't make money. Schrager is realizing that he needs to build a model that can scale. That means reducing the emphasis on expensive, labor-intensive restaurants and focusing on efficient food and beverage operations that can be replicated across properties. Sean Hennessy is a hotel consultant at NYU's Tisch Center of Hospitality. He said, "Public's biggest challenge may be standing out in the crowded hospitality landscape that Schrager helped create." That's the reality. Schrager invented the boutique hotel category. Now there are dozens of boutique hotel brands. The market is crowded. Public needs to differentiate. Public needs to offer something unique. Schrager can do that. But Schrager also needs to execute. Schrager needs to actually open hotels. Schrager needs to actually build the brand. The partnership with Highgate gives Schrager what he's lacked: execution capacity. But it also means Schrager has to share control. It means Highgate's operational discipline will constrain Schrager's creative vision. Schrager is used to total creative control. That's how he's always worked. Now he has to work with operators who care about margins, efficiency, and replicability. That's a cultural shift. That's a potential source of conflict. Let me extract 3 timeless lessons from Schrager and public hotels. First, founder vision without operational scale is stagnation. Schrager had a brand. Schrager had a vision. Schrager had a track record of success. But Schrager couldn't scale public because Schrager wasn't an operator at scale. The brand stagnated for 15 years. The lesson is, founders need to recognize what they're good at and what they're not good at. Schrager is a visionary. Schrager is not a chain operator. Rather than trying to do both poorly, Schrager should have partnered with an operator earlier. 15 years of stagnation could have been prevented. Second, split focus and distributed capital allocation lead to underperformance. Schrager was focused on Marriott's Edition brand while trying to expand public. Schrager didn't have enough capital available for expansion. The combination of split focus and capital constraint meant public got underinvested and under-executed. The lesson is, if you're going to pursue an initiative, commit capital and focus to it. Don't split your attention between multiple initiatives unless you have the scale to do both well. Schrager didn't. So public suffered. Third, founder legacy motivations can drive capital allocation decisions that are good for the founder, but not necessarily for shareholders. Schrager said he wants to have a big company because he's never done it before. That's a legacy motivation. That's the founder's ego. That's not the same as, I want to maximize shareholder returns. When a founder's motivation shifts from economic returns to personal legacy, you should pay attention. That's when capital allocation decisions can become risky. Here's my closing conviction. Ian Schrager is one of the most talented hospitality entrepreneurs in history. Schrager created Studio 54. Schrager created the boutique hotel category. Schrager knows how to build brands, but Schrager couldn't scale public alone. Schrager lacked the operational infrastructure and capital to execute. Now, at 79, Schrager is trying one last time, with Highgate as the operational partner. This could work. The combination of Schrager's creative vision and Highgate's operational scale could produce something valuable. But it could also fail because Schrager and Highgate have different incentives. Schrager wants to create, Highgate wants to scale and optimize. Those incentives don't always align. Public's challenge is standing out in the crowded hospitality landscape, The outcome will depend on whether Schrager and Highgate can work together without the partnership destroying what makes Public unique. The risk is that, in the pursuit of scale, Schrager's creative vision gets diluted. The upside is that Schrager finally gets to build the company he's never built before. Here's the sentence you'll remember. When a legendary founder partners with an operator at the end of his career, you're watching the founder's last act, and it's unclear whether the ending is triumph or compromise. Moving to next title, Kimberly-Clark posts higher profit. Kimberly-Clark posted strong earnings this week. Profit rose. Volume grew. The company beat analyst expectations on earnings per share. Then on Thursday, shareholders will vote on a $40 billion acquisition of Kenvue. That's the story. This is about a company that's performing well and using that momentum to justify a transformative acquisition. It's about a CEO who's confident enough to make a massive capital allocation decision while everything is working. And it's about whether combining two consumer products giants actually creates value or just creates complexity. Let me explain what's happening and why it matters for how we think about capital allocation in mature businesses. Kimberly-Clark is the maker of Kleenex tissues and Huggies diapers. The company sells consumer staples, tissues, diapers, personal care products. These are low-growth, high-margin, defensive businesses. People always need tissues. People always need diapers. The category is mature, but it's stable. It's profitable. It's predictable. For years, Kimberly-Clark has been a classic consumer staples play. Dividend-paying, steady cash flows. Not exciting, but reliable. Then came the acquisition of Kenvue. Kenvue is Johnson & Johnson's former consumer health division. Kenvue sells over-the-counter medicines, first aid products, vitamins, and supplements. The deal is valued at $40 billion. That's a massive acquisition for a company like Kimberly-Clark. The deal is designed to create what Kimberly-Clark calls a global health and wellness giant. The idea is that combining Kimberly-Clark's tissue, diaper, and personal care products with Kenvue's OTC medicines and wellness products will create a company that touches more aspects of consumer health. A customer might buy Kleenex tissues, then buy Kenvue's cold medicine, then buy a first aid kit, then buy Huggies diapers, all from the same company. The theory is that this cross-selling opportunity and the combined scale will create value. Now, this week Kimberly-Clark reported earnings that made the case for the acquisition. Fourth quarter profit rose to $499 million, or $1.50 a share, compared with $447 million, or $1.34 a share a year earlier. Adjusted earnings per share were $1.86, ahead of estimates of $1.81. Revenue fell slightly, 0.6% to $4.08 billion. But that decline reflects Kimberly-Clark's exit from its private label diaper business in the U.S. Stripping that out, organic sales growth was 2.1%. That's growth, not decline. Volume grew in North America and internationally. This is the key metric, volume growth. Most consumer products companies are struggling to grow volumes because consumers remain under pressure. Consumers are cutting spending. They're trading down to private label. They're reducing consumption. Kimberly-Clark is growing volumes. Mike Hsu, Kimberly-Clark's CEO, said the volume growth has been driven by the company's investments in innovation, both for its high-end products and value products. The company is appealing to both premium customers who want quality and budget-conscious customers who want value. That's a difficult balance to strike. Kimberly-Clark is striking it, Hsu said. We feel good about that. Regarding shareholders' support for the Kenvue acquisition. He noted that, of shareholders who had already cast their votes through Monday, more than 90% were in favor of the deal. That's a strong signal. That's not a close vote. That's overwhelming support. Hsu expects the acquisition to close in the second half of the year. So the deal is moving forward. The shareholders are supporting it. The CEO is confident. Now here's where I want to focus on capital allocation. A $40 billion acquisition is massive. For context, that's roughly 1/3 of Kimberly-Clark's annual sales. Kimberly-Clark's annual revenue is around $18 to $19 billion. A $40 billion acquisition is nearly 2 times the company's annual revenue. That's a leveraged acquisition. Kimberly-Clark will need to take on debt to finance this. Kimberly-Clark will need to integrate 2 complex organizations. Kimberly-Clark will need to find synergies and justify the premium. The question is, why is Kimberly-Clark making this acquisition now? The answer appears to be, Because the consumer products category is mature and slow growing, and Kimberly-Clark wants to get bigger and more diversified before the industry consolidates further. Think about what's happened in consumer products over the past 20 years. Procter & Gamble has become a dominant player through acquisitions. Nestlé has become a dominant player through acquisitions and diversification. Unilever has consolidated through acquisitions. The industry consolidation trend is toward bigger, more diversified companies. Kimberly-Clark has traditionally been focused on tissues, diapers, and personal care. That's a good business, but it's somewhat narrow. By acquiring Kenvue and adding OTC medicines and wellness products, Kimberly-Clark is expanding its portfolio. Kimberly-Clark is becoming a health and wellness company, not just a tissue and diaper company. The theory is sound, the logic is sound, but is the price right? Is a $40 billion acquisition the right use of Kimberly-Clark's capital? Let me think about the trade-offs. Kimberly-Clark could use $40 billion to 1. Make the Kenvue acquisition and integrate two companies. This creates a larger company with more diversified revenue streams, but it also creates integration risk, execution risk, and the risk that synergies don't materialize. 2. Return the $40 billion to shareholders through dividends and buybacks. This would be attractive to income-focused investors and would acknowledge that the company doesn't have better uses for the capital internally. 3. Make smaller, more targeted acquisitions in faster-growing categories. Instead of one huge acquisition, Kimberly-Clark could make multiple smaller acquisitions in areas like beauty, personal care, health-focused products. 4. Invest in organic growth and innovation. Kimberly-Clark could double down on innovation. Invest in new product development. Invest in digital channels and e-commerce. Kimberly-Clark has chosen option 1, make the large acquisition. The CEO is confident that this is the right decision. Here's the reality check. Integrating a company of Kenvue's scale is difficult. Kenvue has a different business model than Kimberly-Clark. Kenvue is OTC medicines and wellness, a category with different customer dynamics, different distribution, different regulatory requirements. The overlap between tissues and cold medicine is less obvious than it seems. Yes, there's a health and wellness theme, but the actual business operations are quite different. Kimberly-Clark is an expert at diapers and tissues. Kenvue is an expert at OTC medicines. Combining them requires building new capabilities or acquiring those capabilities through the people and organizations of Kenvue. The integration risk is real. The question is whether the strategic upside justifies the risk and the cost. Kimberly-Clark is making this acquisition from a position of strength. The company is growing volumes. The company is beating earnings estimates. The company is performing well. That's actually when the most dangerous capital allocation decisions get made. When things are going well and a CEO becomes overconfident about the company's ability to pull off a complex acquisition. Let me extract 3 timeless lessons from Kimberly-Clark's $40 billion acquisition. First, making massive acquisitions from a position of strength is when companies take the most risk. Kimberly-Clark is performing well. Volumes are growing. Earnings are beating estimates. The CEO is confident. In that environment, it's easy to become overconfident about the company's ability to execute. It's easy to believe that we're so good at what we do, we'll be great at this new category too. But combining two mature consumer products companies is complex. The risk is real. The lesson is, the best time to be most cautious about acquisitions is when the company is performing best, not when it's struggling. Second, diversification through acquisition is a bet on management's ability to integrate and extract synergies. Kimberly-Clark is betting that combining tissues and diapers with OTC medicines will create a health and wellness giant. The bet is on management's ability to find customer overlap, find cost synergies, and build a more valuable combined company. If management executes well, the acquisition creates value. If management doesn't execute well, if integration takes longer than expected, if synergies don't materialize, if costs exceed projections, the acquisition destroys value. It's a binary outcome. The lesson is, diversification through acquisition is only attractive if you have high confidence in management's ability to execute. Otherwise, return capital to shareholders. Third, large acquisitions in mature categories are often about defending market position rather than creating growth. Kimberly-Clark is acquiring Kenvue partly because the tissues and diapers category is mature and slow-growing. The company wants to expand into adjacent categories before competitors consolidate. But that's defensive capital allocation, not offensive. The company is trying to get bigger before the industry consolidates. That's a valid strategy, but it's not the same as pursuing high-growth opportunities. The lesson is, be clear about whether your acquisition strategy is offensive, pursuing growth, or defensive, maintaining position. Different strategies have different risk profiles. Here's my closing conviction. Kimberly-Clark is a well-run company. The company is posting strong earnings. The company is growing volumes when many competitors are struggling. Mike Hsu is a competent CEO, but a $40 billion acquisition is massive. It's a bet-the-company decision. It's a decision that will define Hu's legacy as CEO. The question is whether the acquisition actually creates value or whether Kimberly-Clark is simply paying a premium to get bigger in a mature category. If Kenvue is available at a reasonable price and management can execute a clean integration, the acquisition could be value creative. But if Kenvue is overpriced relative to its growth and margin profile, the acquisition could destroy shareholder value over the next 5 to 10 years. Shareholders are voting 90% in favor of the deal. That's a strong signal of support. But large acquisitions have surprised investors before. Integrations have been more difficult than expected. Synergies have been elusive. This acquisition will be watched closely. Here's the sentence you'll remember. When a mature company makes a massive acquisition from a position of strength, it's often a sign that growth is harder to find organically, and management is making a defensive bet that size and diversification will justify the cost. Now, towards last article, meme stock seeking autism remedy spurs probe. The stock is worth $15.5 billion. That's not a typo. That's not hyperbole. That's the market value of a company with no business. A company with no revenue. A company with no credible path to profitability. A company facing a federal investigation. This is a story about what happens when capital allocation completely disconnects from reality. And it's a story that matters because Regencell is not alone. Let me explain who Regencell is and why this matters for understanding how markets actually work. Regencell went public in 2021 at 11 cents a share. The company claims it is developing traditional Chinese medicine, herbal formulas, to treat autism spectrum disorder and attention deficit hyperactivity disorder. That's the business plan. Herbal remedies for autism and ADHD. The company is incorporated in the Cayman Islands. The CEO is Yacht Guy Ao. Ao owns 89% of the company, so the CEO owns the vast majority of the shares. The public float is thin. That means there are very few shares available for trading. In fiscal 2025, the company reported a net loss of $3.6 million. The company spent less than $1 million on research and development, mostly to pay salaries and benefits. No actual drug development, just salaries. The company filed a report saying, and I'm quoting, "There is substantial doubt regarding our ability to continue as a going concern." The auditor agreed. The going concern is the most dire warning a company can issue. It's saying, we might not exist next year. We might run out of cash. We might have to shut down. The company had $4.9 million in cash and investments as of June 30th. The company reported that the average cost to bring a new medicine to market is nearly $4 billion, sometimes more than $10 billion. Regencell has spent less than $1 million on R&D. The company doesn't have $10 billion. The company doesn't have $1 billion. The company doesn't have $1 million left to spend. The company also noted that according to the U.S. Centers for Disease Control and Prevention, there is no cure for ADHD and ASD. The CDC says there is no cure, yet Regencell's pitch is that the company is well positioned to become the leader in providing the treatment for ADHD and ASD. That's the entire business plan. Herbal formulas to treat diseases that have no cure. No research infrastructure. No money. No employees. 10 people on the payroll. Now watch what happened to the stock. On screen, you're seeing Regencell's share price from February 2025 to January 2026. Look at this chart. The stock was trading at around 30 cents in February. Then it starts climbing. By mid-June, the stock hits $78 a share. That's 260 times the price it was trading just a few months earlier. At $78, the company had a market value of $38 billion. That's for a company with 10 employees and no revenue. Then the stock collapsed. It fell from $78 down to single digits. Then it started climbing again. By January 7th, the market value was $26 billion, after more than doubling in 3 sessions for no readily apparent reason. On screen right now, you're seeing the chart through January 2026. The stock peaked at around $78 in mid-June. It's now trading around $29. That's still a $15 billion market value. Last Friday, the stock jumped 22% in the opening minutes of trading, only to give back its gains by noon. The day before, the stock rose 40% on no new information. This is pure speculation. This is meme stock mania. This is the market completely divorced from reality. Now here's where the reality check becomes important. In October, Regencell said it received a subpoena from the Justice Department. The Justice Department is investigating the trading of Regencell's shares. The company said it was cooperating. The department sought records about the company's operations, finances, and accounting. Why would the Justice Department be investigating Regencell? Probably because the stock price movements don't make sense. 40% daily moves on no information. 40% moves in minutes. 60% moves. 260 times gains over a few months. The Justice Department is investigating whether there's manipulation, fraud, or insider dealing. But the stock keeps going up anyway. Why? Because enough people are betting that someone else will pay a higher price tomorrow. The meme stock dynamic. The momentum dynamic. The greater fool theory. Here's what's revealing about Regencell's situation. The CEO owns 89% of the company. The public float is thin. The stock is prone to explosive short squeezes. If you want to short Regencell, you have to borrow the shares. The cost of borrowing is exorbitant. The company only has a few shares available in the public float. So the mechanics of the stock market create a situation where the stock can move dramatically on small volumes. One trader owns 89%. The public owns 11%. Those 11% are trading wildly. The CEO is watching his stake become worth billions of dollars, even though the business is clearly worthless. That's the incentive structure. The CEO has no incentive to make the business work. The CEO has an incentive to keep the stock price high. Keep the meme stock momentum going. Keep people buying. The CEO owns 89%. Every dollar the stock goes up is $100 million to the CEO. Wait, let me do the math. If the company is worth $15.5 billion and the CEO owns 89%, the CEO owns about $13.8 billion worth of stock. That's enough money to make the CEO one of the wealthiest people in the world. For a company with 10 employees and no business, Regencell's charter says it's in the dark about the details of the Trump administration's plans. Wait, that's wrong. Let me correct that. The article is about private equity lobbying the Trump administration to open 401(k) accounts to private equity investments. That's a separate story. Let me focus on Regencell. Regencell is just a meme stock, a pure speculative vehicle. The company has no fundamentals to analyze. There's no revenue to model. There's no cash flow to project. There's just sentiment, just momentum, just the bet that someone else will pay more tomorrow. And the Justice Department is investigating. The company is going to burn through its remaining cash, paying legal fees. The company might not exist in a year, but the stock keeps moving. On screen, I want you to see the Regencell chart one more time. Look at the volatility. Look at the disconnection from any fundamentals. This is what happens when speculative fever takes over a market. This is what happens when capital allocation decisions are driven by meme stock momentum instead of business fundamentals. For most investors, Regencell is not actionable. The article says, shorting it could be even riskier than holding it. That's the trap. If you try to short it, you can't borrow the shares. The CEO owns 89%. The public float is too thin. You could short it anyway and hope the stock declines, but the short squeeze risk is enormous. The stock could move against you dramatically on a small piece of news or momentum. So the only rational choice is, don't buy it, don't short it, just watch it. Watch it as a window into market dysfunction. Let me extract 3 timeless lessons from Regencell. First, when a founder owns 89% of a company and the stock trades on meme momentum, the incentives are completely misaligned with business performance. Yacht Guy Ao doesn't need Regencell to succeed as a business. Ao needs the stock price to stay high. The founder's incentive is to ride the momentum wave, not to build a valuable company. When founder ownership is this concentrated and the business is speculative, the founder has every incentive to let momentum do the work. The lesson is, be extremely skeptical of founder-owned companies trading on speculation. The founder's financial incentive is often to keep the speculation going, not to fix the business. Second, thin public floats and concentrated ownership create the conditions for violent price movements that have nothing to do with business fundamentals. Regencell has a tiny public float. Most shares are owned by the founder. The public float is so thin that small volumes can move the price dramatically. Add meme stock momentum, and you get 40% moves in a day on no new information. The lesson is, stock price volatility is not a sign of opportunity. It's often a sign of poor liquidity, concentrated ownership, and speculative momentum. Those are reasons to avoid a stock, not buy it. Third, a Justice Department investigation into stock trading is a massive red flag that should terrify investors. Yet Regencell stock keeps moving higher. The Justice Department is investigating the trading of Regencell shares. This suggests possible fraud, market manipulation, or insider dealing. Yet the stock keeps going up. This tells you that momentum and meme stock psychology overwhelmed fundamental concerns. When the market ignores a federal investigation into stock trading, it's a sign that rational analysis has disappeared. The lesson is, when the market ignores catastrophic risks, it's often because meme stock psychology has taken over. That's when you should walk away, not participate. Here's my closing conviction. Regencell represents everything that's broken about capital markets at the fringes. A company with no business, no revenue, no employees, facing a federal investigation has a $15 billion market value because meme stock momentum trumps fundamentals. The CEO owns 89%. The CEO is watching billions of dollars accumulate as the stock price moves up on no information. The public shareholders are betting on momentum. The Justice Department is investigating. The company will likely run out of cash and cease to exist within a year or two. Yet the stock keeps trading, keeps moving, keeps offering the dream that someone else will pay a higher price tomorrow. This is what speculative mania looks like. This is what happens when capital allocation decisions are driven by herd psychology instead of business analysis. This is the fringe of the market. But for index funds and passive investors, this is also a warning. Index funds own the entire market. Index funds own Regencell. If you own an S&P 500 index fund, you own a tiny piece of a company with no business. Not because you want to, but because the index includes it. That's what happens when the fringe of the market becomes so disconnected from reality that $15 billion companies exist with 10 employees and a federal investigation. Here's the sentence you'll remember. When a zero-revenue company with a Justice Department investigation reaches a $15 billion valuation, you're not looking at an opportunity, you're looking at the market's complete failure to allocate capital rationally. This is Avi. Like and subscribe. On to the next.